Today we're going to be talking about costly investing mistakes. Most people don't lose money because of bad luck, but because of poor decision making. Today we're going to be talking about how these costly mistakes can cost investors millions in profits. And we'll explain how to fix or avoid them. You've probably made them before. All investors have. But making them is not the issue. Not fixing them is the issue. So, if you want to learn how to do this, keep watching and I'll explain it to you step by step. So, the first mistake we have is chasing hype stocks. So, we've all had the feeling, the fear of missing out, or seeing a trend of people buying the stock. But not all these people are buying for the right reason. Some of these investors are buying for speculation or not actually valuing the business on its fundamentals. For example, we have meme stocks like GameStop and AMC, which had huge gains, but then crashed massively. Or tech bubble in 2001, in the 2000s. Well, I think that's the most perfect example. We saw so many companies IPOing, pets.com, many others, worth nothing. But you get it on the stock market, people would invest and see how much money you can get out of investors. No business fundamentals behind it at all. This is obviously what we're trying to avoid. So, how do you avoid it? Well, what's important is to do your own research and make sure you understand the fundamentals and don't buy without a margin of safety. So, when you are doing your research, don't buy a stock, obviously, because you see it on social media. You should be trying to understand where its revenues, profits, and costs come from. And if this is sustainable or growing, then make sure the company is following its fundamentals. So, prove that they have a strong track record, a good board of directors, good management team, and you can trust their judgment and their positions moving forward. And when you're buying with a margin of safety, it's obviously important, as what's worse than buying an overpriced security? You can't win. The stock will either crash drastically or it will expand but pretty much stay even to the price that you bought it at. The second mistake is trying to time the market. No one can do it. Economists from all over the world try, but no one knows when the bottom and the top of the market will be. Even the investment professionals like Warren Buffett, Charlie Munger, and Bill Ackman, and many others have failed to do this. The biggest problem is you miss the best days. So just 10 days have just missing 10 of the best days in the last decade would have cost you a 50% of your portfolio's growth. When you think about that, it's incredible. But those investors who are trying to time the market, who buy at the top and sell at the bottom, they're missing those days of massive growth for the chance that they'll pick at the right time, which never happens. They also their emotions ruin their timing. They believe that this certain period is right, not because they know, but because they can feel it. They're too focused on their emotions, which can cause them to be swayed by FOMO or herd mentalities. So, what we can do to avoid this is either having a long-term investment strategy where we hold stocks for significant periods of time, or dollar cost averaging. So investing a fixed portion regularly, no matter what the market condition is. Third mistake is not understanding what you own. Too many people buy stocks without understanding what the company does. Sure, I'd say you know what Google is. I'd say you know what Amazon does. I'd say you know what Apple does. But what does Nvidia do? What does AMD do? What does TAP do? You don't know. You might have an idea if you look at the reports and what they've put out in their news, but genuinely, you're not fully sure because it's a difficult thing to understand. So, you probably shouldn't be owning those companies. Companies that you don't fully understand the reason or the how they are making their profits. So, because this can cause many people to buy and sell, increasing volatility in these securities, as well as it matters less if they're making money and just the growth statistics that they're putting out. Signs you don't understand the business is you're panicking when the stock drops despite having good quarterly earnings or good business performance. You can't explain the business's model in one sentence, and you bought it just because someone recommended it. Sure, how many people bought Peloton at 140 plus without realizing that it was a pandemic trend and the stock completely collapsed after people were going back into the office and not working from home as much? So, what can we do to fix these problems? Using the one sentence test, can you explain this company in one sentence? If you can, then you probably understand the business model and know what you're looking for in the fundamentals. You consistently read the annual earnings reports and investor presentations given by these companies. This means that you understand these presentations and documents normally contain all the risks and business opportunities, as well as a guide on who are in the management team and what they're currently doing to improve the business. And then, what you should always do, as Warren Buffett says, is stick to what you know. Sure, if you know how trains work and you've always been interested in them, well then, why would you not try and invest in Canadian Pacific Rail Company? It would be perfect. You could know exactly what they're thinking. You'd know why they're doing it and have a just reason to understand how the company could grow profits or market trends that a normal investor would not see. The fourth mistake is ignoring risk management. One of the worst ways to lose money in an investment is not understanding the risks that a company has and something going terribly wrong. For example, if a company is over-leveraged or you have a significantly small amount of diversity in your portfolio, some investors, they want to have investment returns all in their best idea. which can cause a complete over-reliance on the performance of one or two stocks. But this also means if one or two stocks fail, you can lose an incredible amount of your total capital. So, what we have to avoid is putting all our money in a single stock or very few, having too much leverage on companies we are investing in, and not having a broad market portfolio based on not just the United States but also international and growing markets such as China and Asia and India and others similar to it. So what we can do is diversify our portfolio to a good amount, roughly 10 to 15 high quality stocks. We should never use margin, as this can force you out at the bottom of a market, and keep a significant investment in all regions of the world. And the fifth mistake is selling stocks too soon. Some investors sell great companies too early because they get impatient. Others hold bad stocks too long, hoping they'll recover. Here are the two major problems that are made when selling stocks. When you sell your winners too early and hold your losers too long. Selling winners and taking a small gain but missing up on the long-term growth can be very attractive in the short term, but when you miss a annualized return of 10 to 15%, even going up to 20 to 30, this could very negatively affect your portfolio. While holding losers too long and refusing to admit that they're bad investments can cause you to hold companies that lose out on the technological front, such as Blockbuster or Kodak, leading to total losses or close to bankruptcy proceedings. As well as, a great example of stocks that could have been sold too early would be selling Amazon in 2002, right after the recovery from the dot-com bubble. And then you would have missed out on the 100x that has happened since then. So, to fix this, we have to have a clear exit strategy. When the fundamentals change, you sell the company. When the valuation metrics show that it is overpriced and you wouldn't buy any more or wouldn't hold, you should sell. So, also, let your winners run. If a company is growing and the valuation metrics are in a okay margin, probably 10% margin of safety area or 5%, still under your intrinsic value projections, you should keep them running and not take profit just yet. But you should cut your losers. So if a company starts to fall or fail, you should look at their business fundamentals, understand if this is a long-term trend or just a undervaluation of their upcoming results. And then, if so, change your portfolio accordingly. If you've made any of these mistakes, don't worry. It's part of the learning process. The key is to recognize them and learn from them before they cost you more money. So, your next steps should be to start investing with a long-term mindset while avoiding hype stocks, managing your risk, and understanding your investments. I hope you have enjoyed the video and learned lots. Thanks for watching, and we'll talk to you later. Bye.